Welcome to our 2025 webinar series. Throughout this year's series, we will journey to the galaxy of insurance planning, making stops at various planets to see what each world of protection can offer. Each webinar will last about 50 minutes, and you must be logged in for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We will answer all questions as best we can. Today's webinar is being recorded and will be posted on our website within 24 hours. Today's presenter joined LLIS in 2015. As a specialist in life, disability, long-term care, and hybrid solutions, she's happy to be a resource in assisting advisors and their clients with all aspects of insurance planning. Here to present on long-term care is Taylor West.
Thank you, Valley, and thank you, everyone, for joining me today. We are going to be talking about long-term care, a world of long-term care, and the different options that clients have to protect themselves and protect their families in the event of long-term care. The good thing about long-term care is, not much has changed in the market. So if you tuned in with me last year, there's not going to be a lot of updates, but that shows a lot of stability in the market, but it might not be as exciting for you. But I'm going to try and make it as exciting as I can as we venture to the aging planet. So today I am going to cover quite a few things. I am going to talk about some facts and figures, different statistics of long-term care and long-term care insurance. Then I am going to cover rate increases. This is one of the most common questions and policy review requests that I get each week. So I want to kind of dive into rate increases, what caused them, and what the future looks like. Then I will go into different long-term care solutions, talk about traditional long-term care insurance, touch on hybrid life and hybrid annuities. So first, I wanted to really dive into some of the cost of care. Whenever I am beginning to plan, create some illustrations for clients and advisors, the first thing I do is look at the cost of care in that client's area. And what I really want to illustrate here is how it varies across the country and even more so within these states. But I'm going to just talk about states. And here I want to highlight some of the highest cost of care. So these are daily cost of care. You can see the assisted living and nursing home figures are for a one-bedroom or a private room in these facilities. So in South Dakota, you can see that the home health care cost of $276 is pretty high. As a reference point, the maximum daily benefit that we can start at is $300. So we're already kind of pushing that maximum benefit available at policy issue. The nursing home cost is really only about $30 more. So, the home health care cost is quite high in comparison to nursing home costs. If we look at Alaska, home health care cost daily is about $213. But look at that nursing home daily cost, almost $1,000 a day for a private room in a nursing home. And then we look at Hawaii, $266, $372, $538 for these daily costs of care. They're just kind of consistently on the higher end for each of these different types of care. Let's look at the lowest. Louisiana, $138 a day for home health care, and only up to $250 for a median cost of a private room in a nursing home. Texas, home health care and assisted living, both under $200. Nursing home care, a little over $200. And in Illinois, we're looking at $300 and below for all types of care there as well. So with this, you can see how much these vary across the country and how protecting a client's, assets in the event of needing long-term care, that cost and that type of coverage can really vary depending on where they live and where they might want to retire. So we see how much it costs. How long do we generally need care? Well, women need care longer than men. That's just how it is. We have longer life expectancies. Because we're living longer than men, the likelihood of women needing to use long-term care is a lot higher. So if we look at the average duration of a long-term care claim, for men, that's about 2.2 years. Women, 3.7 years. So we have some general rules of thumb based on these averages of what type of care and benefit periods we look at for couples or single men or single women, which I will touch on a little bit later. Statistically speaking, because women are living longer than men, men's health starts to deteriorate a little bit earlier. So whenever they're needing care around the house and needing help transferring or toileting, the spouse, the wife is there to help with these needs. But when the husband dies, no one is necessarily in the house to take care of the wife. And that's why a lot of times claims are longer, and those claims are longer in facilities because that is where more comprehensive care can be provided for the female. And here we kind of go into where care is received. 73% of claims start in the home, and the longest duration of claims are paid out for home health care. I think we can all agree that we'd prefer to stay in the home as long as possible before we are in a facility. 18% of claims in assisted living facilities, and 9% of claims are paid out in nursing homes. And let's look at the policy usage. For clients that have long-term care insurance, 67% of claims end due to death. So it might not seem like a high number, but that is the majority of claims are ending because clients are passing away while they're on claim. And 20% of claims, their benefits are stop being paid because the insured actually recovers. They no longer need benefits to care for or to be cared for. And only 13% of claims end because the policy's benefits have been exhausted. So that is a pretty low number if you think of all of the clients out there that have their own policies. They're actually able to have the coverage that they need without exhausting those benefits. So when do we see claims begin? This isn't going to be a big surprise for most of us. Majority of claims start between age 80 and 84. Second to that, 85 to 89. And then next of that highest range of claims is going to be 75 to 79. So like I said, this probably isn't all that surprising. Based on loved ones that we have in our life, whether it's parents or grandparents, we're seeing at about age 80 how that health does start to deteriorate, causing them to need more assistance around the house or with medications, whatever it might be. That's when we really start to see clients utilize their long-term care policies. So how do we pay for care? Well, the first option is to self-insure. By self-insuring, it does have a big impact on income and assets. And if we're using kind of our savings or retirement funds, it affects the ability to pay the day-to-day expenses. Things like a mortgage, those funds might not necessarily be there to take care of those day-to-day expenses. And if care is needed early in retirement, we're depleting these savings that we've put away to last us for another 30 years. And if we use up all of these funds that we have set aside, the surviving spouse doesn't necessarily have what they need to pay for care or to pay for those day-to-day expenses as well. It also has a big impact on family members. So aside from the financial impact that not necessarily preparing with a policy and just self-funding, it doesn't only have an impact on our wallets and our savings. It has a big emotional and physical impact on our family members. And so a lot of clients that I talk to, their main concern is making sure that their kids don't have to take care of them, and they don't have to necessarily provide that care and be as involved in that care. Caregivers not only have, an emotional effect of being a caregiver, but it also can affect their finances. Maybe not being able to work as much and having a cut in their pay because a lot of their time is spent with their loved ones providing that care. So that emotional and physical burden is there. And of course, it leaves less assets for a legacy for your surviving children and family. So we always have option 2, and that is to transfer the risk by purchasing a long-term care policy. There are linked benefit solutions that I'm going to cover, hybrid life or hybrid annuity long-term care policies. But by having a policy for yourself to prepare for a long-term care event, it does protect that income and the assets. You don't have to spend down assets to qualify for state-funded programs like Medicaid to pay for care. And we're able to protect those assets and actually still pass on and leave a legacy to our loved ones. And the main point that I like on this page here is that it allows your family members to manage your care, not provide it. And by just being able to visit their parents and know that the parents are safe in a facility or with a legitimate home health care company, they're able to manage that care but not provide it. By having a policy, you're not going to be dependent on government programs or family, and you have the choice of the care setting. If you want to remain at home and you're able to remain at home, you have benefits that pay for that. Or once things get a little progressed, you can go into an assisted living or a nursing home care. And you can also choose which facility that you would like to go to. With state-funded programs like Medicaid, not all facilities accept Medicaid funds for you to stay at that facility. So it allows you to really choose and have an opinion and a choice in the care that is provided. A lot of these companies have built-in care coordinators that at claim time can help set up a care plan, can help find care providers in your area, and also help with the claims process, submitting those expenses each month to be there for you and family members as they help manage care. So we know that it's important and a really, really great option to protect yourself by having an individual long-term care policy. But when do we purchase long-term care? I get this question all the time. What is the best age? And there isn't a direct answer. There isn't a magic age that long-term care should be purchased. But a few things to take into consideration is family history. So as we get older, our parents also get older. And for long-term care, insurance companies are looking at family history with cognitive impairments. So even if we ourselves are in perfect health, certain companies won't even consider clients that have a family history of two parents with a cognitive impairment. So not only are we kind of locking in our own insurability, but we're also locking in our family history as it is at that time. At about 65, we're going to go through Medicare health screenings, which can reveal different health conditions that can make clients uninsurable. So by applying early, we can lock in premiums, at a younger age, and we also lock in our own insurability health-wise. So when is the best time to purchase? We look at a female. I used a female here at age 45 because females pay so much more for long-term care based on that longer life expectancy. The cost can sometimes be a sticker shock for females. So if we look at age 45, annual premiums a little over $2,500 a year. And a lot of times I hear, well, if I get a policy early on, I'm ultimately going to be paying longer. So does that make sense? So I wanted to illustrate that here. So if she pays this premium for 35 years with the assumption that she goes on claim at age 80, she's going to pay a total premium of a little over $89,000 over her lifetime. At age 50, she's paying for a shorter period of time, but that total premium she's paying in jumps to over $95,000. At 55, that jumps to a total of $104,000, even though she's only paying for 25 more years. At 60, $112,000, 65, up to almost $121,000. And then at 70, you see that total premium go down, but that's only for 10 years that this client would be making premium payments. So there is a little bit of a sweet spot of the best age to apply. I say depending on the type of coverage that a client is looking into and based on their health and family history, 50 to 55 is a really good age to at least start truly thinking about long-term care at 50 and by 55 to have coverage in place. Because long-term care underwriting is very stringent. And so you can see with these declines, by the time a client gets to age 70, we're looking at almost a 50% decline rate. So if you think about that, 1 out of 2 clients is not being approved for long-term care. So these decline rates are very high in comparison to any other type of coverage that's sold and that is being underwritten for. Even age 50 to 59, 20% of clients are declined. That's a really big percentage for even such a young age. So it's important to at least start thinking about long-term care by your late 40s. Just start looking at what those costs might be, what type of coverage you'd be interested in. Because unlike life insurance, long-term care doesn't have several rate classes. I can run term quotes, and there's 12 different rate classes that a client can have. 4 standard rate classes and 8 more substandard. That is not the case with long-term care. In most scenarios, it's an approval or a decline. And some common underwriting obstacles: arthritis. You can think of different conditions that would ultimately make it likely that a client needs assistance later in life. So a lot of these are going to be joint related. So arthritis. If clients are on specific medications for arthritis to slow the degeneration of arthritis, that can be an automatic decline. Physical therapy in the last 6 months. I can't tell you how many times a week I am sending emails to clients or advisors saying you don't qualify at this time because you were recently in physical therapy. And I want to note that physical therapy isn't just based on whether it be for pain or after a surgery. It can even be voluntary physical therapy to just get your body moving better, to gain some more strength. Any physical therapy, the client has to be finished for at least 6 months to qualify for long-term care. And that's across the board. Changes in anxiety and depression medications. One company will not consider a client if they have had any changes in anxiety or depression meds in 24 months. So 2 years, if a client has even had a small change in the dosage, they will not accept an application or approve coverage. Neuropathy, it's an automatic non-starter. Family history, as I mentioned, and significant comorbidity. Long-term care is, different than life insurance, and that it's going to pay out in a lot more scenarios. So with certain conditions that on their own might not be concerning, in combination with other medical history, it can result in a decline. So unfortunately, with long-term care, it's definitely the type of coverage that I am having to deliver bad news the most, which is unfortunate. But as you know, here at LLIS, we try and set those expectations up front. So I really like to gather as much medical and family lifestyle history from clients as I can up front so that I can say, I don't suggest we apply right now. Or I can do some pre-underwriting to confirm which company might be more lenient in the diagnoses and the medical history that that particular client has. But unfortunately, long-term care underwriting is quite stringent. So next, we will talk about these rate increases. I'm sure a lot of you guys have had clients that come to you with rate increase letters, from old Genworth policies or John Hancock policies, really from any company that was selling long-term care in the 80s and 90s. Clients are most likely getting some pretty big rate increase letters. And so I wanted to talk about why there are rate increases today and then what it looks like from here on out. So rate increases really are happening from 3 things. And the first is lapse rates. Second is interest rates and underwriting. So in the 80s and 90s, when insurance companies started selling long-term care, they didn't know what they were doing, right? It was a new product and they didn't have claims data. They didn't have any sort of claims history. They also didn't have these actuarial data that they needed for long-term care. So a lot of the things that they were basing premiums and underwriting on was for life insurance. And as I said, life insurance is going to pay out in one scenario, and that's death. Long-term care is worried about a client living too long and needing assistance, not dying too early. So what they first started doing was using lapse rates from life insurance, and that was about a 4% lapse rate assumption. So if we really scale this down and say that they had 100,000 policies on the books, after a year, they assume that there'll be 96,000 still in force. But after 10 years, we're looking at 66,500 policies that are still on the books and still active. So we oversimplify that. The insurance company, if they need $1,000 per year to pay out benefits, they can charge everyone $665 since only 66,000 policies are going to be in place in 10 years. Well, they were wrong. That 4% lapse rate was not accurate. So after 10 years, rather than 66,000 policies in force, there were over 90,000 policies that were still on the books. So in a scenario where they were charging $665, they should have been charging over $900. And like this says, this is oversimplified. So this is only 100,000 policies. When we're talking about, hundreds or millions of policies that are now on the books, that number is huge. And so just with this one aspect, they were already in over their heads before they even knew what was coming at them. And then take into account interest rates. So insurance companies collect clients' premium payments, and they invest those premiums to pay out claims in the future. And so these interest rates is how they can calculate how much they need to collect from clients, in addition to those lapse rates, right? So part of that pricing is based on an interest rate assumption today and over the next, several decades. So when they started selling long-term care policies, our interest rates were high in the 80s. But as you can see here, those immediately started dropping. And not only did they start dropping, they stayed low. So the insurance companies didn't even earn the interest that they were planning on those premium payments. So they weren't earning money that they expected on the premium payments, and the premium payments themselves were too low anyways. So there we are 2 for 2 on a not so successful story for long-term care companies. And then thirdly, with it being a new type of insurance, they didn't have that claims data. So they were approving clients for unlimited benefit periods, 5% compound inflation riders, and a lot of clients that were approved back then would likely be at least postponed, or if they were approved, it would be with a higher premium or with limited benefits, maybe a limited benefit period or a limited monthly benefit. We see that very often today. And most likely they might have been declined for coverage altogether. So it was kind of the perfect storm of missteps that got these companies upside down and needing rate increases very early and continue to need them today. But there is good news with this being said. Today's policies are priced with exponentially more claims experience. The companies that are still in the market today have learned from the past companies' mistakes. And those policies that are sold today are using lower and conservative interest rates. They are also using very conservative lapse rates, more like 1%. And the underwriting is significantly more strict. The Society of Actuaries released a study in 2022 saying that the chance of long-term care insurance premiums increasing is less than 10%. And that is for policies that are sold since about 2020 on to today and here in the future. And if there is a need to increase premiums, they would likely be 10% or less. And of course, it's never ideal to have premiums increased, even if it is 10%. But when you think of 10% in comparison to a letter that I saw recently from a Genworth settlement of a 300% increase, it makes a lot more sense. But even with these increases, I kind of wanted to show how pricing differs just with pricing from 2005 to today. Of course, there's some inflation involved in this, but you'll see the difference in what the same benefits cost. So Gina and Giorgio, 59 and 61, purchased an LTC policy with a $100 daily benefit, a 5-year benefit period each, 5% compound inflation rider, and it included a 20% spousal discount. And that combined annual premium was $23.91 at the time of policy purchase. So even in 2005, that's, not a low premium, but not high enough for the claims experience that they need to pay out these claims. So 20 years later, in 2025, we're looking at a male and a female, the same age as the previous couple, with a $100 daily benefit, 5-year benefit period, and a 5% compound inflation rider. That starting annual premium is almost at $7,800. So you can just see a $5,000 difference in the exact same benefits from 20 years ago to today. And as this says, by charging more and accurately, it allows the potential for future rate increases to be much lower because they have prepared by pricing these things accurately and by underwriting correctly as well. So what do clients do when they receive a rate increase letter? Well, the first thing to do is send it our way so we can review what coverage they have. Let me see what coverage they have, what options are being provided, and what the rate increase is itself. Ideally, they are willing and able to accept this higher increase and keep the coverage as is. But we can also look to make some changes to the policy, maybe reducing the inflation rider, the benefit period, or the benefit amount. A lot of clients that I review policies for have, a 6-year benefit period for each spouse or a 5% inflation rider. And the good thing is, the silver lining that I always let clients and advisors know in a scenario like this is they have such a great policy that they have some really good wiggle room. And they have somewhere that they can go and significantly save on premiums while still having a very, very robust and solid policy. So Nancy and Andy have a long-term care policy from 2013. And when they purchased this policy, had a monthly benefit of $4,500, 3-year benefit period with the shared care rider, allowing them either access, to each other's benefits if one exhausts all of their benefits, and a 5% inflation rider. This had an annual combined premium of a little over $3,600. But last year, they received a letter that there was going to be some rate increases and they would be staged over the next several years. So they laid out what those increases would be. And as you can see, it goes up about $2,000 over these next couple of years, up to $6,781. So the first thing that I look at, what would that exact same coverage cost if they applied today? It's a really great reference point. Well, they're 9 years older, and that $4,500 monthly benefit has grown to almost $7,700 a month because of that 5% compound inflation rider that they have on the policy. But 5% inflation riders are very expensive these days. And so, with a 5% inflation rider and their current coverage, that $6,700 annual premium would be up to $27,000 a year today for that exact same coverage. So a lot of times, as I said, that reference point allows clients to feel really good about the coverage that they have. And even though the rate increase isn't ideal, it's nowhere near what it would be if they applied today. And that's also assuming that they medically qualify today or that they are still within the maximum issue age for a new policy. So as I said, we can accept the increase. No one likes it, but you could be paying 30% of today's going rate. And as I said, if health has declined, they might not even be able to get a new policy. So my first go-to is reduce the inflation. especially whenever clients have a 5% compound rider. The premium usually goes down significantly whenever they adjust that. The options are usually 1% and 3% that they can change to. This particular client's letter offered a 4% adjustment. So with the planned increases in the premium, the 5% was going to go up to about $4,700, but the 4% automatically brought that down to $3,928. So just by bringing the compound inflation percentage down 1%, they can save $760 a year. So if we did that and maybe brought the benefit period down a year, or the monthly or benefit period down a year, or the monthly benefit down $1,000, that can add up pretty quickly of what type of savings that they can have. So let's get into the different solutions that clients have for protecting themselves against a long-term care event. We have traditional long-term care insurance, and then we have hybrid options, hybrid life and long-term care, or hybrid annuity long-term care. All of these types of policies are going to provide benefits for home health care, assisted living, and nursing home care. So it's going to cover all of the different types of care we might need or choose to have. There's a choice of benefit periods, inflation riders, same 2 claim triggers across the board for every company. And this has not changed much, even with older policies. If a client has been diagnosed with a cognitive impairment and needing substantial supervision, supervision is the key word here. It's not just the diagnosis. So if a client has been diagnosed with Alzheimer's or dementia and they need supervision for their own safety or for the safety of others, they would qualify to start receiving benefits. Or if they need assistance with 2 of the 6 activities of daily living. Those are eating, bathing, dressing, toileting, continence, and transferring. So if they are unable to do 2 of those on their own, they would also qualify to start receiving their benefits. This graph here shows the differences of the different types of coverage. So with traditional long-term care, no, there isn't a death benefit or return of premium. The premium payments tend to be lifetime premiums. So these are going to be a true use it or lose it type of policy, like most of the insurances that we have. You're not going to get a benefit if you don't get in a car accident from your car insurance. So you're paying for the protection in the event of needing it. The premiums are not guaranteed. We just went over rate increases, and though we don't anticipate to see anything like we have in the past, they are not guaranteed. So they can be increased in the future. They are reimbursement benefits. Reimbursement is the most common type of issuing of benefits for long-term care, and that ultimately means that each month that a client is on claim, they submit their expenses to the insurance company, and the insurance company then reimburses them up to their maximum benefit for qualified expenses. And qualified expenses means a licensed and skilled caregiver. Ultimately, a client can't pay their loved one for helping out with their care around the house. It has to be a legitimate organization or facility in order for them to receive or be reimbursed their benefits. It's full underwriting and partnership qualified. Yes, this is not applicable in every state, but long story short, to keep it very simple with partnership, it's a big advantage of traditional long-term care, and it protects clients' assets in the event of needing more care than what their policy has. If a client has $300,000 of long-term care benefits, they use all $300,000 of those benefits and they still need care. The partnership qualification says that they can still have $300,000 in assets and still qualify for Medicaid. So it helps clients avoid spending down and having to be deemed basically impoverished in order to qualify for Medicaid assistance. So these different states want clients to feel incentivized to protect themselves against a long-term care event to kind of take that weight off of state-funded programs. Hybrid policies aren't going to have that partnership qualification because on paper, they are either a life insurance or an annuity contract. They are those types of policies with long-term care benefits, so they don't qualify for partnership. And there are some different functions here, mainly being single premium payments or short premium payments. Hybrid life policies, most of those have indemnity benefits, which are cash benefits, meaning there are no limitations to what clients can use their benefits for. So we'll kind of go into more detail on these. For underwriting, traditional long-term care is going to be mainly based on medical conditions that impact their activities of daily living and being able to complete those. Hybrid life, we're looking at mortality and morbidity. So a lot of hybrid underwriting can be a little more stringent. But hybrid annuities, it's simplified underwriting, and they're mainly looking at the ability to complete ADLs. So hybrid annuities are going to be the most lenient option for underwriting that there is. So we're going to use Sarah and James, who are both 55. They live in Atlanta. We're going to use them throughout the rest of this presentation to compare different types of options and policies. So they reached out, want to know what their options are. So the first thing that I do, as I mentioned earlier, is I look at the cost of care in their area. So the median cost of care in Atlanta is $5,892. So we're almost at $5,900 monthly for home health care. Assisted living, $5,400 a month. Semi-private room and a private room in a nursing home, I usually look at the private room. That is $10,500 monthly. So this is really how I'm going to base what benefits I'm going to show them. So I recommended a $6,000 monthly benefit because this covers 100% of home health care costs, and that's always my reference point. Because majority of claims start in the home and RN clients are in the home longer than in any other facility, we ideally can cover 100% of that number. And that equates to 57% of the nursing home care cost. It's pretty hard to cover 100% of any of these costs based on the maximum limits and just how expensive care is. So this is where I base the benefit. But where do I start with the benefit period? Single women, I start with a 4-year benefit period. Single men, a 3-year benefit period. And for a married couple, I look at a 3-year benefit with shared care because that shared care rider allows access to more benefits than if they don't have that. So for Sarah and James, we have that $6,000 monthly benefit, a 90-day elimination period. This is definitely the most common for long-term care. 3-year benefit period with shared care, and then a 3% compound inflation rider. This looks very similar to what I run all day long. So with these same components and benefits, we're looking at the lowest option for traditional long-term care at $6,377 a year, and that is a combined annual premium. So if we go into the hybrid, there are 2 different options for hybrids, hybrid life LTC policies. One is going to be focused on a death benefit, and it has a long-term care rider that is a percentage of the total death benefit. So it's really more focused on the death benefit. But what I'm going to talk about today is hybrid life policies that are focused on long-term care benefits. And these are going to be the most common and the most that I recommend. I recommend these a lot more than a life insurance or a death benefit priority because this is truly planning for a long-term care event. And great advantages to hybrid life policies is that they have guaranteed benefits, because they're going to be paid out whether it be for long-term care or as a death benefit. They also have guaranteed premiums, so you don't have to worry about whether the Society of Actuaries was right and in a maximum of 10% increase. There will be no increases in these premiums. And there are also flexible premium options. So these are really focused or designed to be funded on a shorter pay schedule. So we're usually looking at a single pay, a short pay, so think 5, 10, 15, or 20 years, or there are level lifetime premium options. They're also great for a 1035 exchange, and they can be funded by a 1035 exchange, partially or fully. They have indemnity benefits. So these are those cash benefits that are super flexible to claim. And we're able to personalize these just like we can with a traditional policy. We choose that monthly benefit. We choose the benefit period. There are still lifetime options available. They are expensive, but they are there for clients who really want lifetime benefits. Inflation riders, usually these are 3 or 5%, and they have a small death benefit. The death benefit is pretty small because, like I said, we're focused on the long-term care benefits here. So we are looking here at individual hybrids for Sarah and James. So they would both individually have hybrid policies that each have $6,000 of a monthly benefit, a 4-year benefit period, a 3% compound inflation rider. The reason why this is 4 years here is that a lot of hybrid companies, their minimum benefit period is 4 years. And also, a lot of times, 4 years is cheaper than 3 years based on whatever goes on behind the scenes at these insurance companies. 4 years can sometimes be less expensive than 3. We also elected the 3% compound inflation rider. So let's compare what these premiums look like for James and Sarah at different levels. So as you can see, I'm going to jump down a little bit to the single premium. The single premium is going to be the least money in. The shorter amount of time that you pay, the less you are going to pay in total. So for James, single premium, a little over $99,000. And for Sarah, we're pushing $114,000. 10 pay, $11,734 for Sarah. It's a little over $13,000. And then the level premium is even lower than that. For both of them, the death benefit is $144,000. So if they don't need long-term care in their life, a death benefit of $144,000 would be passed to their beneficiary, whether it's each other or their children, tax-free at death. Let's look at a 1035 exchange option. These are two clients, a married couple that I just worked with here in the last month and helped them get into some hybrid policies. They came to me and said, we have these very expensive permanent life insurance policies that we don't need anymore. And at our current ages, we are thinking about long-term care. It's time for us to kind of shift that focus to preparing for long-term care. So they both had individual life insurance policies. The female had a policy that had a little over $69,000 in existing cash value. So she said, I don't want to pay anything else. What will this cash value fund in a new policy of a hybrid life long-term care policy? So with that single premium and nothing out of her pocket, she was able to secure a $4,765 monthly benefit, a 4-year benefit period, 3% compound inflation rider with a death benefit of over $114,000. So that's not bad a lot of clients that have these existing cash value policies have funded their long-term care coverage over the last 20 or 30 years through a permanent life insurance policy. It's no reason to get a life insurance policy while you're young to hopefully have cash value later on. But for those clients that have it in place, they kind of have a built-in funding vehicle for long-term care planning. For her husband, he is, a little over 10 years older, and he only had $31,000 in existing cash value. Not saying $31,000 in cash value is not a lot, because that is a good chunk of change that we can use to protect them this next phase of life. So the wife said, I still want to do close to the single premium that I made. So for a $70,000 total single premium, that means we use $31,000 of a 1035 exchange, and then $39,000 of an additional single premium cash. And that's funded for a 69-year-old male, a $3,236 monthly benefit, a 4-year benefit period, 3% compound inflation rider, and over $77,000 in a death benefit. And you might look at these monthly benefits and say they aren't that high, but keep in mind, if we look at this female's age, at age 58, she has a 3% compound inflation rider, and if she doesn't go on claim for another 22 years, at the very least, based on claims data, that inflation rider is doing its thing for 22 years with no additional premiums, and that policy is just going to be there for her whenever she needs it. So this is a really great way to allow clients this entry into long-term care planning based on what they already have. But there's also an option for a joint hybrid life policy. It's not available for those clients that have existing cash value because based on 1035 exchange laws, if there is cash value from a policy that the husband has, he cannot do a 1035 exchange to a new policy and add an additional insured. It has to be a policy that is only insuring himself, just as that life insurance policy was. So in an event that clients just are applying for a new policy without any sort of cash value or anything like that, they're just starting from scratch, I usually am looking at a joint hybrid policy. This is going to function just like those individual hybrids that I just went over, but the death benefit functions more like a survivorship policy. So it's going to pay a death benefit upon the second insured's death if no long-term care benefits were used. Provides long-term care benefits for both. A lot of different benefit period options. We're usually looking at 4, 6, or 8 years. And these benefit periods are shared benefit periods. So if a couple chooses a 6-year benefit period, that means that there is a pool of benefits that will pay out for 6 years. One spouse can use all 6 years, leaving the surviving spouse, with no benefits. They've exhausted the long-term care benefits of the policy. But it can be split up. Ultimately, there's flexibility of whatever life throws these clients. Those benefits are there for them. There's also inflation riders available. So for a joint policy, we still have that $6,000 monthly benefit. They chose a 6-year shared benefit period, 3% compound inflation rider. And for this joint hybrid and the benefits that we've selected here, it has a $216,000 death benefit. So pretty good death benefit for a long-term care policy. And this is what the premiums look like. A single premium, $152,000, $373 for just a single premium. 10 pay, we're looking at a little over $18,000, and a level pay to age 100, $9,600. If they chose the single premium option, they have savings of over $60,000 for applying for a joint policy rather than for individual hybrids. So from a cost perspective, a joint is going to be more beneficial than individual hybrids. So if we kind of look at this comparison here, it's kind of what I mentioned. The premium is going to be lower on the joint hybrid. Let's see, the death benefit is higher for the individuals. Both would have $144,000, so that total is higher than if they have a joint policy. But the long-term care benefits are going to be the same. We have that same starting point, the same compound inflation rider. So they're very similar. It's just going to be what is the better fit for those particular clients and what do their funding vehicles look like. So I mentioned the 1035 exchange laws, and I am pushing time here, so I'm going to go through this pretty quickly, but I always like to bring this up because it's not all that common, but it is a really, really great option for clients where one spouse has cash value. So we can't use cash value from one insured's policy to then insure two people. But the hybrid annuity is the only workaround that we have for that. And it's a common occurrence that one spouse has cash value and the other doesn't. So with a hybrid annuity, it's going to be a fixed deferred annuity with a long-term care rider. Long-term care pool of 96 months for an individual or 102 months for a joint hybrid annuity. These hybrid annuities are not able to be personalized like traditional or the hybrid life policies. It's pretty much, one or two options that are available here. But there's minimal underwriting. So if clients have the ability to pay a single premium, the hybrid annuity might be their only option just from a health perspective. And you can add a spouse to an annuity. So if there's no cash value involved, you're going to have one spouse as the annuitant and the other spouse as a joint annuitant. They are both annuitants on this contract. But if we do a 1035 exchange, the way that this works is if that husband is the one that has cash value, he's going to be the annuitant on this policy. But they allow for the spouse that isn't involved in any cash value to be what they call an eligible person. And what that means, and this is how they do this workaround, the spouse is not an annuitant on this policy. They're an eligible person to receive long-term care benefits from this policy, just like the main annuitant does. So it is the only workaround. Let's say that the annuitant, the husband, passes away. The whole policy is then just passed on to the surviving wife or the surviving spouse. And then the policy functions like her own. She is the annuitant of that policy. So it is a great way to fund a policy, a joint policy for two spouses to have access to long-term care benefits. The funds that are used to fund this policy can be non-qualified only, so we're not talking about IRAs or other qualified annuities. They do have to be non-qualified annuities in order to do a 1035 exchange. And there is an inflation option available, 5% only, and it's only available on part of the annuity, which I'm going to try to explain as best as I can in these next couple of slides. So same couple. Because it's a joint, we're looking at a 102-month benefit period. And for these benefits right here, it is going to take $180,000 single premium. The bottom line, $180,000. It'll fund $6,000 monthly benefit and a little over 8-year benefit period. What I want to show with this is let's look all the way over to the right of this graph, the monthly long-term care benefit. This doesn't include an inflation rider, but you're going to see that these benefits are increasing over time because of the guaranteed interest rates that are built into this annuity. Even without paying for an inflation rider, these values will grow over time. And this is also the guaranteed rates. These aren't just projected. I work very conservatively, so I like to show what can happen and what will happen based on these guaranteed rates. So by year 6, that monthly benefit has already grown $500 a month. But let's look if they elect to have a 5% compound inflation rider. That increases the premium by $105,000. So now we're looking at a single premium of $285,000. And I'm going to go ahead and jump to this screen. So these annuities are broken into two parts. The first is going to be the base policy, which is 30 months. That is your client's money. This is first in, first out. So when a client goes on claim, they are using up their own money first. After those 30 months are up, they are going to start using the insurance company's money. And the insurance company's money, or that long-term care rider, is where the 5% inflation actually affects, right? That is where the benefits are increasing every year by 5% on a compounded basis. So you'll see that after the first 30 months in year 7, they are going to get a $1,000 jump in their monthly benefit because that inflation rider has been working double time on the second set of benefits. So it's not necessarily an intuitive type of policy. Once you get into it and you see these different illustrations, it makes sense. And it also, as I said, is a really great option for those married couples that have a policy with some good cash value, or maybe for those clients that don't have or aren't in great health. This is a really great backup option for them. So to kind of wrap this up, I wanted to provide some rule of thumbs that I have heard are helpful of what type of policy might be a good fit for clients, right? Is $500,000 or less in assets. Those clients probably can't afford long-term care premiums. So at that point, we're looking at self-funding, maybe doing some spend down to be able to qualify for state-funded programs. $2 to $3 million in assets, hybrids might be the best fit in a scenario like that. And for clients that have over $3 million in assets, they can probably self-insure. However, I find that a lot of clients, even at a net worth level that's a lot higher, they still really want to have a pool of benefits that are there for them only for long-term care to still kind of protect their children, not have to go out of pocket, and are really focused on leaving a legacy. Having something in place can be a really nice safety net and peace of mind, ultimately. And then when it comes to hybrids, mainly the hybrid life that I covered, is I find that it is a really great option, and usually the best option, for younger, healthier clients. Think of maybe those clients that are between 40 and 45 or in their late 40s who are pretty high income earners. And they have that cash flow coming in right now that allow them to fund these policies up front, to pay them up by the time they retire. So they're not having to pay anything out of pocket after retirement. The policy is ultimately there for them when they need it, and it's ready to go. Or hybrid life policies can be really great for those 1035 exchange situations. Or simply for the clients that want some sort of guaranteed return. Have a lot of clients that say, I'll pay more just knowing that I'm going to get something back for it. Use it or lose it policies aren't for everybody, especially when you're looking at several $1,000s in premiums each year. So hybrids aren't for everybody, but they are for a lot of people and for a lot of clients, and can be a really great fit. And this is regarding hybrid life long-term care policies. These type of hybrids are for everyone. And if you tuned in last year, you know that I am obsessed, and I love these images of hybrid animals. There's something about them. This cat peacock and the little mice bull, I have stared at the screen for too many minutes. I don't even want to let you guys know. But anyways, thank you guys so much for joining. Jerry Skapiak and myself will be at several conferences throughout the rest of the year, mainly this fall. So if you are in any of these associations, we can't wait to see you, and please always stop by and say hi. Just like this month, we will have 4 more webinars the rest of the year. I think Brian is presenting on term life insurance next month. September will be disability from Kathy. And then later this year, we'll have annuities and TBD on November, so stay tuned for that. Otherwise, I know that there are some questions here, but I am at my full hour, so I will go through these questions and either reach out by phone or by email to answer anything I can. But as always, please reach out if there's anything that we can do, that I can do. And I really appreciate you guys joining me today. Thank you so much.